The U.S. labor market has taken a turn for the worse, and as we delve into the latest trends, it's essential to grasp the bigger picture. Let's first provide some context by taking a look at the jobs created each month from 2022 through 2025. In 2022, job growth was quite robust, with hundreds of thousands of jobs added every month, sometimes even exceeding 500,000. But then, by 2025, things started to decline significantly. While the first few months showed some decent growth, adding around 100,000 jobs each month, the situation quickly worsened. In the latter part of 2025, job losses became more frequent, with October seeing a steep drop of 173,000 jobs. Now let's turn our attention to January 2026, when the ADP report revealed a dismal 22,000 new jobs created by private companies, far below the expected 45,000. The ADP report paints a concerning picture of a slowing labor market. ADP's chief economist said, "Hiring is softening, continuing a pattern we've observed for the past 3 years. Employers are hesitant to bring on new staff amid the current economic uncertainty." Adding to the bad news, the Challenger report, which was released on February 5th, highlighted an alarming increase in job cuts. According to the report, U.S.-based companies announced 108,435 job cuts in January 2026, marking a shocking 118% increase compared to January 2025. This surge in layoffs demonstrates just how much the labor market has deteriorated. Job cuts have doubled in just 1 year. This is not a minor issue. So, where are the most significant cuts coming from? The top 3 sectors hit hardest by job losses in January were transportation, with over 31,000 jobs lost, technology, which saw around 22,000 cuts, and healthcare, where 17,000 positions were eliminated. The healthcare sector's large losses might seem surprising at first glance, given the aging population and the anticipated need for more healthcare workers. However, the economic realities are more complex. Ongoing inflation has forced hospitals to increase wages for healthcare workers, but at the same time, government reimbursements through Medicare and Medicaid have been reduced. This squeeze on hospital budgets has left them with little choice but to trim their workforce. The unfortunate result is not just job cuts, but a decline in the quality of patient care. Now let's break down the primary reasons driving these job losses. Contract losses were the leading cause, accounting for nearly 31,000 cuts. Economic factors such as market conditions and restructuring followed closely, contributing to 28,000 and 20,000 job cuts, respectively. Additionally, nearly 13,000 job cuts were attributed to business closures. As you can see, these factors are all tightly tied to a fragile economic environment. While artificial intelligence, AI, has garnered a lot of attention lately, its role in job cuts is real, though it might seem relatively small at this point. AI accounted for 7,624 job cuts in January, or 7% of the total. However, as someone who works in an AI-powered company, I can tell you that this trend will only accelerate. AI is becoming an increasingly dominant force in various industries, and the impact on jobs will be far-reaching. I work with Clear Value Lending, which helps small businesses secure financing, and we use AI-driven solutions to streamline communication and service. It's a game changer for the industry, and we'll see more companies adopting these tools, leading to even more job cuts. In addition to layoffs, job openings are also shrinking. The most recent JOLTS, Job Openings and Labor Turnover Survey, report revealed that job openings have fallen by 1 million, from 7.5 million to 6.5 million in just a year. We're seeing a decline in job creation, a drop in available positions, and an increase in job cuts. This brings us to an important question. If you're currently job hunting, is the situation as dire as these reports suggest? If you're in the job market right now, I'd love to hear about your experience and how the labor market is impacting your search. Please drop a comment below and share your thoughts. Looking ahead, we have more reports to digest. On Wednesday, we'll get the ADP report, and on Thursday, the Challenger report. However, The most anticipated report is the U.S. government's Bureau of Labor Statistics (BLS) jobs report, originally scheduled for Friday but postponed until next Wednesday due to the partial government shutdown. I'll be updating you on that as soon as it's available, but based on the current trend, it's likely that we'll see downward revisions. Regarding job creation, there is a general expectation of 60,000 jobs being added in January, but given the recent reports, we may see weaker numbers. What does this mean for the Federal Reserve and its interest rate strategy? The next Federal Reserve meeting is set for March 18th. While the Fed has been cutting interest rates to support the labor market, the data suggests that it might be walking a tightrope. If the labor market continues to weaken, the Fed will be faced with a dilemma. Cutting interest rates too much could fuel inflation, while waiting too long to act could exacerbate rising unemployment. Should the upcoming jobs report confirm the worrying signs from the ADP and Challenger reports, specifically if job creation falls short of expectations or worse, turns negative, the Federal Reserve will have some tough decisions to make. A labor market in decline combined with high inflation could lead to a significant economic crisis. Let's take a step back and think about the broader implications. If job creation continues to slow and layoffs continue to rise, what does that mean for consumer spending? We all know that consumer spending is a key driver of U.S. GDP, accounting for 70% of it. As more people lose their jobs or fear job loss, they will cut back on spending. This includes delaying major purchases like cars, reducing travel, and cutting back on discretionary expenses. This could trigger an economic downturn, leading to lower sales for businesses, which will likely result in even more layoffs, creating a vicious cycle. This is why the health of the labor market is so crucial. The Federal Reserve is trying to manage this delicate balance, using interest rate adjustments to prevent further economic deterioration. But with rising job cuts and falling job openings, we may be entering a new phase of economic instability. As we await next week's jobs report, I'm particularly focused on the manufacturing sector. In previous reports, we've seen job losses in manufacturing, and I'm still waiting to see if we'll finally see the manufacturing sector rebound. We'll find out soon enough. If you found this information useful, please subscribe to stay updated. Thank you for your support, stay safe, and be wise.